All right, it is time for questions and answers from my Patreon members. They ask the questions. I provide the answers. I'm going to do a bunch of technical analysis of stock symbols that they've given me and questions regarding stock trading strategy, etc. And I'm opening this up to the public, but only my Patreons can ask the questions. If you're interested in answering a question, feel free to check out my Patreon. There's a link in the description and the comments. It's only $10 a month, and I do a technical analysis of my portfolio and focus list. And I want to jump right in, but first I just need to say this is not investment advice, purely for entertainment and education. I'm just sharing my opinions. You need to make your own investment decisions. And also, please check out my partner, Seeking Alpha Premium, which in my opinion is the best crowdsourced platform for fundamental analysis. I've been using it for many years and get all sorts of great information. With that, let's go to the first question. All right, the first question is from William Sanchez, who asks, how do people allocate their funds to control risk? And he said he knows about the 2% rule. The 2% rule, somewhere along the line, someone came up with this supposedly brilliant idea. The 2% rule is an investing strategy where an investor risks no more than 2% of their available capital on any single trade. So first, I'd love to see in the comment section, how do you guys allocate your funds via position size, via bonds and stocks, whatever, money market funds, and what do you think, how do you control risk? So now let me tell you what I think. So the 2% rule, yeah, maybe if you're managing some $1 million mutual fund, then you can do these little 2% slivers. But let's say you're starting out and you have $1,000 in your investment account. Are you going to follow this rule that you can only use 2%? 2% of $1,000 is $20. Are you going to only allocate $20 to a single stock? No, you can't even buy most stocks for $20. So let me tell you, we need to be a lot more aggressive when the market is saying get aggressive, and we need to be use the 2% rule, or guess what, the 0% rule, when the market is not rewarding us for taking risk. What am I talking about? Progressive exposure. So you start in cash, all right? You're in cash during the bear market, and then you dip in, let's say 3 toes. You open up 3 tiny little positions. Now maybe these are 1 or 2 or 3 or 4% positions. Maybe you just buy 2 shares, 5 shares, 10 shares, pile a position, and then you let the market give you feedback. If you do well, if they run up to 10%, and you close them for 10%, or they're open at 10%, and the market's not giving you much pressure, then you progressively expose. You open a few more positions, or you add to those positions, and you keep doing that. And it's a dance, right? You progressively add, or you progressively reduce exposure until if those trades are not going well, then you reduce exposure. And if you did $1,000 trade, the next one's 500, then 250, then 125, then you're out of the market. But eventually, the way to get rich is to put on a few big positions where you have tight stops, and you put in a big chunk of your account into these positions. For me, the largest size position I'll take is 25% of my account. That sounds crazy, but if I've got, a 4% stop on a 25% position, sorry, just was getting a text there, and I nailed the purchase price, nailed the pivot point. I know there aren't any sudden announcements scheduled to come out, then that's actually, I don't want to say safe, but the reward is way higher than risk. Let me tell you something. Mark Minervini, 2-time U.S. investing champ, he sometimes has put his whole account in one position during raging bull markets. So I think the 2% rule, yeah, I don't follow it. Let me know, how do you control risk via position size? How do you allocate your funds in the market? Let's look at the next question. Okay, my next question is from JJ, and her question is pretty complicated, so let's just look at it here together. If you could go over low cheats versus William O'Neill's strategy using some charts. Okay, so we can do that. So O'Neill came first, and he, what can we say, popularized. He did this exhaustive study with thousands of charts over decades and realized that stocks are making the same patterns over and over again, most commonly cup with handles and double bottoms with handles, both. And so he realized what he did was he perfected buying out of these two patterns and a few others, but mostly these. So when what he would do is buy out of a cup with handle. So here essentially, here's your cup, here's your handle, and he would buy the breakout on the handle. And here's your cup, and here's your handle, and he would buy the breakout on the handle. And this works really well in strong bull markets. It works, and then it gets progressively worse depending on the conditions of the market and also the size of the stock. The large caps are much more random walk theory. They have so many eyeballs on them that they don't make these charts nearly as well, and patterns nearly as well, and they tend to just make V bottoms and such. Let me pull up an Apple. Okay, so see how V-shaped this Apple chart is? This is really characteristic of the mega caps. They just don't make our patterns as well. Whereas if you look at, I was just looking at, where is it here? IMVT. Look at this nice head and shoulders bottom, power play, pull with flag, and then we have a failed cup with handle, and then here we have a really nice cup. So that's one thing to consider. Anyway, that was a tangent. So O'Neill perfected buying out of the cup with handle. Minervini realized that he could cheat and get in on these patterns earlier and get a bigger move out of them. And then also, since the big caps aren't making these traditional patterns and breaking out of them as well, that he noticed that it was especially effective on the mega caps. So basically, he does a variety of different types of buys, but he buys the low cheat and the cheat, and then also sometimes from the handle. So here's Lilly. This is one of the stocks I have in my Patreon portfolio. So here we have this cup. Now O'Neill would have waited all the way for this handle to develop. Now this handle is not very well developed. It's short, and we want it to droop down, not wedge up. I guess it drooped just a little bit. In any case, O'Neill would have bought it when it cleared all of the supply right here. But what Minervini does is he buys the low cheat. So you watch the left side develop, and then when you think it's made the turn, you let it break that downtrend line, retest, and then when you've decided it is done retesting and starting the right-hand side, then you buy what's called the low cheat. And that's what I did here. I bought the low cheat. Now, a lot of times about halfway up, it'll pause out, make a little handle, and then you can buy what's called the cheat. This one didn't really do it. I mean, it made a little one-day pause pivot here. So I guess if you bought here, you could call that the cheat. And then what I often do, well, when it runs up to the top of this right-hand side, I'll take half off. And then if it makes a nice handle, I will add back on when it breaks out. And sometimes not only will I add those previous shares, but I will add more shares. And that, JJ, is what is called as trading around the position. You have a core position and you add to it and you reduce it depending on the chart's behavior. Let's look at, you were talking about the cheats with LNTH and HOLX. And we'll look at those. Let me show you one more good example of cheats. So here's 𝐼MVT. This is another one from my Patreon portfolio. So here's your left side. It breaks the downtrend. It retests. Then you would buy right here. That's your low cheat. And then it goes a little bit farther, sets up again, breaks out again. That is your cheat. That's where I bought it. I missed the low cheat. I didn't see it. And then what I've done is sold for a 16% gain as it comes into the supply. Now when it makes a handle and then breaks to the upside, that's where O'Neill would buy, and that's where I will add on those shares, possibly add more. But there's no guarantee. It might bounce off of this and it might slide sideways for weeks or months, or it might roll over and come all the way back down. That's why I usually take off half when we get to this resistance, unless we're in a really strong market and stocks are all blasting out of these patterns. So LNTH, you were asking about LNTH, the cheat, and I just sold this one. So again, so you want a prior uptrend. Here is your cup. Now this cup is too deep, but that's just the nature of the bear market, sorry. So you figure out when the downtrend is over, and this is art, not a science. But so here's the end of our downtrend. You let it break, then you wait for a natural reaction, and then for it to confirm the natural reaction. And then here is your low cheat, right here. And then, now here you'd have to get creative. It pauses out again. You could have done a pullback buy right here, and that would have gotten you in before this big gap. Otherwise, you would have had to wait and buy the cheat where I did right here. And then I bought another cheat right here. This is really too short to be a handle. What I wanted to see is for it to pause out and make a longer handle. Instead, it broke through the pattern, and I sold half for plus 17. Now it's coming down. It's probably going to bounce off of the 50-day moving average. Why do I have the, oh, my trend lines are all messed up. I got the 50-day on here twice. Anyway, it'll probably bounce off the 50-day. HOLX, if you were going to buy the cheat on this latest pattern, here is your left side. Breaks through right there, pulls back, retests. This is a little sloppy. I probably would have not made this buy, but in hindsight, obviously, the spot to buy was right here. And now it's come up. It didn't really offer, it made a low cheat. It didn't really offer a cheat. And then this handle is just way too wild and loose. But in theory, if this handle had tightened and drooped, then that's where O'Neill would have bought. Okay, then you said Perry sold someone a dip below my stop at 35, now considering buying it back at 35. Yeah, so this is not a buy right now. You've got huge, let me turn that up. You've got huge selling volume. You've got this wide bearish engulfing day engulfing this whole ledge. You don't want to see a ledge. This is the stock's trying to rally, and stockholders are selling into any little rally. Ledges are really bad. You want tennis ball action. This looks like it really wants to go down. In fact, if this opened to the downside, that would make a decent short, in my opinion. But yeah, you do. I often buy back the same stocks. There's stocks like NVIDIA. I've been in and out of them, I don't know, 10 or 20 times, and made a little bit more money than I would have if I had just held it. But the main thing is I controlled my risk, because stocks don't go up forever, right? And so by selling when the chart is saying sell, you control your risk. Did I show the low cheat on Lilly? I can't remember. Left side breaks the trend. Wait for a little pullback. In this case, I waited for it to get above the 200-day. Here is your low cheat. Didn't really make a cheat, and then here's your handle. I think I already did that, didn't I? Oh well, who knows? Now here's your other question. Let's see. When to just take profits, lock in 10% sell versus playing for a bigger move, setting your stop below the 50-day. It seems you use both strategies. So this is an art, not a science. I can't give you a black and white answer, but the weaker the market, the more quickly I take profits, and the larger percentage that I take. So in a bear market, In a terrible market, I'm in cash. I'm taking profits at 5%, full profits. In a convoluted whipsaw buck and bronco market, like right now, I take off half at 10%, and then the other half, if I like the fundamentals, if I like the story of the stock, then I will backstop, move my stop to my purchase price, and then I will gradually maneuver the stop until it's a couple points beneath the 50-day moving average, if I'm so lucky for that to happen. Then I just trail it up behind the 50-day. But sometimes I don't do that. Sometimes, if it's a fad stock or something that's making an early turn and I don't think it's going to run for a long time, then I'll take full profits at 10%. Now, when we have a strong bull market, and we will, then I wait and I don't take anything off until 20% or 25%. And some of them I'll play the whole thing for a bigger move. When will we know that that's happening? When you see a bunch of stocks running to 25% before setting up a base, then you'll know, don't take any profits to 25 until 25%. Okay, Charville asks, please compare and contrast BCX and PFE. Both are multi-decade cup and handle breakouts. Okay, so let's look at the one-year charts first. Here's BSX, Boston Scientific, an established biotech. It's been in a nice uptrend this year. We've got kind of a malformed head and shoulders base here. Shoulder, head, shoulder. With a handle, support off the 50-day. Breakout with a little supply, so it's not surprising that it pulled back. And then maybe you try a pullback buy right here. Certainly you buy it right here. Look how it's extended now. See how high it is from the 50-day? It's too high. We need to let the 50-day come up before we entertain buying it. And look at this big sell volume. I don't like that at all. So if I'm in this stock, awesome. I'm certainly not buying it right now. And here is Market Smith. Yeah, okay, I see what you're saying. This huge multi-year cup with handles since 2004. That's great. You know the saying, right? The bigger the base, the farther into space. So these things have potential to really go into space. So I really like that. In fact, I'm going to put this on my, what's it called? On deck list. Here's my on deck list for my Patreon. I'll give you a little sneak peek here. Let's just add this to on deck. Sorry. Okay, got it. So, yeah, that makes me definitely more interested. And looking at the numbers, profitable company growing in profitability, no dividend numbers. Great quarter last quarter for a pretty large size stock. Margins came in a little bit. Now, what's the other one? PFE. Boy, this is an ugly, ugly chart. Don't take this one to the prom. Okay. Gosh, what do we even say? So you got some whipsaw action here. You got a V bottom. Is this a large cap? I'm betting this is a large cap. A little bit of a ledge that broke, testing new lows. This isn't a confirmed downtrend. If anything, I would be shorting this, but let's look at Market Smith. So yeah, it went from $6 this year in 22 to 3.4 in 23. Definitely profits are shrinking at the moment. Poor last quarter. Monthly chart. So I guess maybe you're calling this a cup and handle. And yeah, it is, but it failed to launch. The train failed to leave the station. Here's your cup, here's your handle, and then it should just go. And it tried, and then it meandered for years. And now you've got a little bit of a cup and pulling back all the way. You know, this might get support here soon at 40. I don't like it. There's so many better charts around. I would stay away from this one for now, me personally. Of course, you do what you want. One thing you can do if you have Seeking Alpha Premium, my partner, link in the description, is you can look up these stocks, BSX and you can read articles about it. Let's see. Boston Scientific stands out with strong diversified growth. So we know the chart's doing well. We could read these articles, find out why, and see if it's something that we might want to hold long term. Okay, a couple questions from 𝗏𝙗𝗵𝖵𝗨. Can you please analyze the scenario that happened with Mobileye, where on earnings the stock falls 30%, then on the same day itself it gained 15% and +5 today? Is the institution selling right into much stronger institutional hands, or something else is the reason? Would love to know your thoughts. So this is a classic gap down on earnings. Okay, so a lot of this is probably retail. We've got a nice prior uptrend. This was really setting up nicely, getting support along the 50-day. And then we had a breakout here, but the volume was above average, but pretty lackluster. That's mostly retail. And then pulled back, gave us another little bump, but volume again lackluster. And then we had some pretty high volume selling. We probably had some institutional selling ahead of earnings. Then you have this huge gap down and this big bounce, which we often see when the retail expert fundamentalists swoop in and say, my gosh, Mobileye is now 30% off. It's such a good value here. I'm going to buy. We get what's called a dead cat bounce. The dead cat bounces, the smart money, any institutions who got trapped and or more educated, shrewder traders who got trapped waited for the dead cat bounce, and then they unloaded into strength, and then it rolls over again. And if you're lucky, it'll slide sideways for a while and start making a new base. A lot of times, though, it ends up crashing and going beneath the original gap down. That's how I interpret that price action. Spinning top doji at the top of an uptrend. After a long uptrend, a spinning top doji often marks the end of an uptrend. So keep that in mind. Now this was kind of a malformed one. Didn't do that. But yeah, when you have spinning top doji and then a down day the next day, that would be a time to start selling some shares. Your other question, all right, let me read this. Okay, this is a complicated question. Fixed comfort systems. On FIX, April 26th, the volume was large, but it moved the price only 2.5. But on the 27th, the volume was a bit less, but it moved the price up 11.5%. Is this an indication that the supply has almost been dried out of the stock? Or is it just that the base area has very strong support? Kindly look into my doubts when free. Okay, so here is the 26th and here's the 27th. So you've got the left side of a base, and then you've got, this is almost a bullish engulfing day. The stock opens down low on big volume, rallies, and it closes above what would that be? Open of the prior day. It didn't close above the top wick, if you will. So basically, yeah, that's an indication that this downtrend is over, at least short term. First of all, you've got all this support right here, but you just had a whole bunch of shares change hands. A whole bunch of sellers sold, and then a bunch of buyers bought and pushed the stock up on a high volume. And then immediately following, you have this wide ranging day on big volume. That, of course, is big buying. And yeah, so all of the sellers sold the previous day, so there was very little supply coming to market. So yeah, it ran up really rapidly. Now the right side is compressed. We need symmetry, and this right side of this little base is compressed, so it needs to make a handle here, preferably droop down and spend some time and make a handle. This is making a fan shape. That's the opposite of what we want. We want price action to tighten up and calm down, not fan out. Okay, I'm going to do 3 more real quick, and then I got to move on here. Okay, so Sanjeev Sharma wants to hear about GLBE, BWMN, and NVEI. Okay, so GLBE, Global E Online. I don't like this at all. This is moving sideways. It is above its 200-day and was above its 50-day. So it's just starting what we call an early turn. But we want this in an established uptrend. We want it to either be a power play up 100% in 2 months, or we want it to be an established uptrend of at least 4 months. This is just getting established. 10-year chart. We want this bottom to be in the upper half of this base. So 82 to 20, I don't feel like doing math right now, but somewhere around the 50 mark. So personally, I would wait for it to come all the way up to the 50s, and then maybe it will start making a place for us to get in, and then the uptrend's established. I don't care about the lowest price. I don't want the lowest price. I want the lowest risk price where it's going to move the fastest at the shortest amount of time. BWMN, I like this one a lot better. I think this is on my focus list. Let me, yeah, it's on my, and this really looks great. 10-year chart, all-time highs, highs make new highs. You've got a nice base here, nice prior uptrend, got strong support on the 50-day. That's probably one or more institutions buying, and it's making kind of a double bottom, trying to make the right side. Boy, it kind of is getting heavy recently. There's obviously supply coming on at 30. What we want to do is for it to get up here near the $30 mark, tighten up, volume to die down, and then punch through there and close above 30, then put on a half position because you got a little bit of supply here, and then work your way towards a full position. Now sometimes you can buy these bounces, but this is sitting on the 50-day, not bouncing. We don't want stocks to sit on the 50-day. We want them to bounce off of there. So I'm not touching this one until it does what I mentioned earlier. The other one, NVEI, this one is an early turn. I like it better than Globe, but it's still really early. This new uptrend is only one, gosh, I don't know. Since it crossed the 200-day, it's only 2 months. I like to wait 4 months. Now you can buy these things, but you're going to want to trade them because they're going to be really volatile. They're going to tend to steeply come back down and do retests. It is getting support off the 50-day. If you wanted to try to swing trade this thing, I would have really bought this hammer off of the 50-day, or at right now, I'd want to wait for it to get above this supply at like 43 or so. What did we say the 10-year chart was? Yeah, see how all of these trap buyers has got to fight against years of trap supply. Now, granted, a lot of these guys are long gone, but this is an upside down chart. We don't want to be fighting our way through supply. So this is probably going to be a pass for me for now. In a couple months, once this gets established, then yeah, I'd take a swing at it. And if we contrast it with NVIDIA, which is pretty similar, but see how the price is now getting near the top of that base, and look at the uptrend. 1 month, 2 months, 3 months. It's a good 3.5 months long. This is one that's further along that I'm thinking about moving into. I want to see this base go longer. Okay, guys, that is over 30 minutes. I have got a life to live here, and you guys have other things to do too. Thanks for listening. Let me know if you have any questions or comments. I'd love for you to check out my Patreon. It's only $10 a month. So I do this on the stocks in my portfolio and focus list. Every single weekend, I post some blog posts. Check out Seeking Alpha Premium. You get access to all sorts of fundamentals and amazing articles. And that, my friends, is it. Take care.